Hi there, thanks for tuning in. In this video, I would like to give a little brief overview and introduction into the stock market. If you've seen some of my other videos, this is kind of a new template that I think I might be trying out and running with, so let me know what you think of it, and if it works out well, then I'll be doing a couple more in-depth videos about stock market items through this presentation. And this is your first time watching one of my videos, welcome. I hope you enjoy this. Let me know if this video is helpful to you. So without any more random notes, let's just go ahead and get started. The overall purpose of this video is just to give my very broad understanding of the stock market so that anybody who has possibly heard of stocks and not entirely certain what they are, this is hopefully something that will give you a really basic intro view so that you can kind of get more in depth later on, but this will give you a starting point because I myself am still learning, still relatively new to the stock market, so I hope that gives me a bit of a more relatable perspective to help just shed some light on what overall you would be getting into if you were to, go further and move into the stock market and trading stocks, etc. So let's go ahead and get started with what we're going to kind of slide through here. Yes, this is the PowerPoint. I apologize. I know that some people are still scarred from school or you're still in school, but they are an effective way to just stay on schedule. So overall, we're just going to start off with kind of like my definition of what stocks physically are, and then a couple ways that you can go about actually buying them, selling them. And then we're going to go through a difference of investing and trading, pretty much just a personal goal kind of topic. And then we'll go through some of the outcomes of what stocks give you, such as the gains and dividends. So that would be where you actually profit, why people buy these stocks. And then we'll go into a couple more specific topics that are not too relevant to the overall broad, but I think that they should be included into something just because there's such common things to know about it. So I hope that I can make this brief and make sense to you. Let's go ahead and get started. So first of all, what are stocks? You've probably heard about them if you're watching this video, and you may already have this much information and knowledge about them, but again, this is my personal understanding and definition of it is that stocks are securities that represent proof of partial ownership of a company. So if, for example, Microsoft, you bought a stock of a share, as it is in the parentheses, of Microsoft, that would mean you are partially an owner of that company. So what you can do in a lot of situations is buy one of two different types of stocks, though. So not a lot of people are initially aware of that when they first jump into the stock market, is that most people think of common stocks. That's our first type. And that's what a majority of those are, is because you have that partial ownership, which means that you're able to vote and receive dividends. So for the first part of that, you're allowed to vote. Whenever there are public decision-making topics and committee meetings, we technically have the right to put in a vote for each share that you own of that company. So a lot of individual owners, I don't believe, tend to actually go and vote, but larger investment firms and hedge funds that have large amounts of shares, they could really sway the vote that goes in for a company because they have a lot of shares. But you yourself, if you disagree with something or you want to try to push something through that's like up for a vote in the company, if you're a shareholder, you have the right to vote for something that could happen in Microsoft. So that's the first part of having a stock. The second one is that you're entitled to receive dividends. And we'll go in depth with that further, but basically that's a payout from the company. So you get money from the company, and that's one of the reasons why you actually buy stocks as an individual investor. Now, the second type of stock, which is less common, is known as preferred. And what's special about these is that they don't have voting rights. So they're a little bit separate from that, whereas they don't actually get a say in what the company does. But when there are things like dividends that get paid out or certain special assets get liquidated and kind of paid out in a special dividend, the preferred stocks get paid before the common stocks. So if there's only enough money to give a certain number of people payout, these preferred stocks will get it first. It's not too common, but the more common application for getting those is that you will have a minimum payout, whereas with a common stock, the company could pay you more, pay you less based on how well they did, whereas a preferred is at a set rate of payout. So that's just a brief overview. I don't want to get too far into depth about that, but those are pretty much the two main types of stocks that you can actually see on the open market. Now, when a company initially decides to go public, they perform what's called an initial public offering, or commonly referred to as an IPO, which is where they are trying to raise money for the company to go and reinvest. So they take those shares, which are basically votes in the company, and sell them to the public at a price so that they can raise money and reinvest that into their own assets or equity, whatever their business is. And that's how we initially start getting shares to be able to buy, is because people are saying, I'm interested in having a say in this company, so I will pay $20 for each vote that I get to do on your future investments. So that's initially how a company gets put into the stock market. Is they say we'll sell 1,000,000 votes into the market right here out of 5 million that maybe they'll have, and people in the public will bid on them so that they can have a say in what the company does. So that's pretty much everything for the stock side. As far as what kinds of companies that you'll see, there's all different kinds that are divided mostly into these things called sectors. That's kind of what's happened to the market now, is we have, I believe there's 13 off the top of my head. I could be wrong. But they're basically divided based off of what the company does. So, if you're familiar with NVIDIA, they're a tech-related company that make GPUs. If there's a healthcare company like Pfizer, they're pharmaceutical. Actually, that's under healthcare. Anything in consumer staples would be its own sector. So, Walmart, the store Staples, pretty much any kind of consumer retailer that you can think of, and there's other sectors like that, but that's what most of the stock market is separated into. Is most companies, I'm saying most, but some of them might be able to be grouped into a couple. They'll just be grouped into a sector, and that's kind of just based off of what the company does. So if you're really interested in the tech sector, maybe you'll have more investments and stocks in there. If you work at a hospital or something and you know more about healthcare and it interests you, there's a whole sector full of different companies and stocks that you can look into. But it is always recommended to stay broad in your investments. So try to reach out into a little bit of each sector if you can. Now, we know what stocks are and a little bit about why we get them, but how do we actually start getting into trading stocks? Typically, these are sold. I say typically because there are some older methods I think that are still around, but in the US specifically, they are mostly sold on two things called exchanges. One of them is the New York Stock Exchange, the other one is the NASDAQ. I actually had to Google this acronym because I've never actually looked up what it stands for before. But basically, these are two platforms that people can go to and commonly pay each other for their stock and shares. And they've just really built up over the last years. There's a few other ones, I believe, building up a little bit now, but for the US specifically, these are the two main platforms that will be trading shares. So you've probably heard of the New York Stock Exchange in movies and stuff. That's what it is. Now, on a more personal level, what you would have is a broker who actually interacts with these exchanges. So you yourself would not be talking to the New York Stock Exchange saying, hey, I want to buy 20 shares of Apple. No, you would talk to your broker and they would make the transaction with that exchange for you. So some common brokers are Fidelity, TD Ameritrade, Robinhood is a new one that's really taken up, Charles Schwab, lots of different investment companies, pretty much the same people who run the 401ks and stuff for your company and Roth IRAs, which are both listed down here later. A lot of those investment firms will offer personal brokerage accounts so you could talk to them about it. But you would just sign up an account, put in money like you would with a savings, or checking, I guess would be more accurate, and you can spend that money to tell them, hey, I want to spend $50 buying these shares, and they'll go make these trades for you on those two exchanges. Now, another way that you could go ahead and buy stocks specifically, like one at a time, instead of just doing a blanket of them, like you would in a 401k, which we'll get to, is a IRA, which is an individual retirement account. And the most common one that people get is a Roth, which means that it's an after tax. If you're not familiar with that, basically the money that you get from work and everything gets taxed, and then you put it into here so that it's already been taxed once. That's kind of the main benefit is you're not going to get taxes on that account when you pull it out later because you've already been taxed on it. So that's just a little brief definition on a Roth IRA, but they will also do a similar thing like a brokerage. They're also commonly run through that brokerage. So like Fidelity, TD Ameritrade, they'll commonly have IRAs available for you as well. And that's basically more like a retirement focused account versus a personal brokerage, which could be, a 2 to 3 year buy and sell kind of deal and then pull out money later. Whereas an IRA is typically held until you're retired. And the biggest thing that people do with these is put in special stocks that have tax benefits to them. Because this is a tax-free account, then there are some companies that have special payments that work better because you've already paid taxes before going in and buying them. Whereas on a personal brokerage, that comes in as normal income and you would just pay for every single transaction that you make money on in there. I don't want to get too in-depth to it, but that's basically the main difference between the personal brokerage and the IRA is that you already paid taxes on the Roth, and that's the main thing that I can think of. The other thing, we're not going to talk about preferred. That's from the previous slide. I guess I forgot to take that out. I apologize. Let's move on to the next one. If you have a company job and they have a 401k, then you're probably very familiar with this already. But there are some 401ks that actually let you buy specific stocks if it's for the company you work for, as far as I understand. A lot of the times, though, what you'll do is you'll set up a distribution through that 401k to say, I want to put 20% of my contribution into bonds, another 30% into large cap stock, and so on and so on. They'll have different brackets of groups of stocks is kind of what they'll set up so that you're not physically looking at stocks yourself. You're looking at areas of stocks, and they'll manage each individual stock for you. And that's pretty much what a 401k would do to trade stocks. So that one doesn't really count as much as the others, but it is still technically interacting with the stock market. And if you're not familiar with what a 401k is, that's basically a retirement account that you set up with your company where, maybe they'll offer a benefit or maybe they'll put some money into that 401k for you and just kind of help you save up for retirement. Just real quick if you're not familiar with it. And the last main way to get into the trading stock market is to set up a mutual fund, which is kind of mix one that's similar to the IRA. I guess it can sometimes be part of an IRA, as I said in here. Basically, it's just when you have it's similar. It's like a blend, I would say, between a 401k and an IRA, because you're basically setting up a personal account for somebody to just go ahead and manage all your money in stocks for you. So you would tell them, here's $10,000. I want to open this up and have you go invest in a bunch of different large cap stocks, and they'll invest into those individual large cap stocks for you. So you can define kind of what your goals are, where you want to invest into as a general area, and they will invest into the specific stocks for you. So those are the main ways to really get into the stock market. If you're watching this, you're probably mostly interested in the first one, which is getting a personal brokerage account. But it's always good to remember that there are other methods of getting into the market too to help you kind of diversify your portfolio. Now, the next thing, really kind of more of a personal opinion versus definition thing, is investing versus trading. You'll probably hear about this from more experienced investors. Is that uh, just for me personally, I've heard a lot of people kind of complain about it, so I've thought I'd prepare you. Is that most people say the difference between them is the length of the goal as far as your timeline, because people will say investing is when you say you're looking for 10 years down the road, 15 years down the road, you're looking to see how a company will progress and grow and give you money to help retire or do some kind of long-term goal. I mean, this isn't my personal definition of it, but uh, I'm pretty sure you'll agree once you're more familiar with seeing how other people on the different trading sites and different trading groups on social media discuss this. So that's investing. Is I'm going to look into the 10 years down the road. Is this company going to do well? I'll invest in them and watch them grow. Whereas trading is more of a short term outlook, because you may be just trying to get some quick cash. You may be trying to buy and sell stocks and try to build up some wealth more quickly. So you'll say, "Oh, this company is about to have some really good news. I think I'm going to buy them now. Hopefully that good news works out. They shoot up. Then I'm going to sell them for profit. Go somewhere else." That's what the more general perception is of trading, and it doesn't have to be a week. It could be shorter for a couple months and just do a medium sized trade. But typically, if you're looking into longer, people say it's investing. Shorter, they'll typically say you're trading. All right. Now, the part that everybody wants to actually learn more about, and again, as I said, if this template works out well, I'll get more in-depth videos about these specifically, and be able to draw on some of these presentations, give more examples. But the main things that people are interested in as personal investors are the capital gains and the dividends that they get from buying and selling stocks. So let's start with capital gains. That is the difference in price between when you bought a stock and when you sold it. So basically your net profit, or not net profit, but your gross profit. So in our first example here, say you bought a stock for $10, and then a few months later you sold it for $15. Your capital gain is the difference between how much you bought and sold. So you would have made $5. That's your capital gain. Now, if you had bought it for 15 and you sold it for 10, that's a negative $5, but it's still called a capital gain. Now, don't ask me why, but I think it's just because it's easier to keep it listed as one definition in Word. So even if you're losing money, it's still called a capital gain. And there's ways that you can report that on your taxes and kind of save some money off of losses, but that's for other videos. I think I may have already posted one about it. Now, when you have capital gains, there are two types of capital gains. And again, this is something I discussed in another taxation video because they are taxed differently. If you have a short-term capital gain, it's because you bought it and sold it within 1 year, like the example above where we only hold it for a few months. So anything that's less than 1 year between the time that you bought it and sold it, short-term capital gain. Anytime that you've bought it and sold it after holding it for more than a year. So for the example above, if you had held it past March 1st, 2019, and then sold it, it would be qualified as a long-term capital gain. And there are some tax benefits to having stocks held for a longer time. So that's why they're kind of differentiated between those two types of capital gains, is because you will save money on taxes if you hold it longer. The other kind of main thing that people look for on buying stocks is dividends, which are payments directly to the stock owners from the company's profits. So like I mentioned, if you have that common stock or the preferred stock, you will be entitled to receive dividends anytime the company pays them out. So what will happen is, if a company made some money and they did well, they will take some of their net profit and just pay it out to investors. So in our example here, we'll say that stock XYZ, good company, they made a really strong quarter, made some profits, and they decided to say, hey, let's reward our shareholders for their faith in us with 10 cents per share that they own. So in that example above, you only had one share, but you made 10 cents on it out of a $10 investment. That's pretty good for just waiting a little bit. And if you have 20 shares, then you'll have made $2. And the common trend is that companies will pay these dividends every every 3 months or each quarter, or some of them pay monthly. Some of them pay special random dividends, and sometimes they're a little more intermittent and only pay them sometimes. So there are some stocks that are really well known for paying good dividends, and some of them that have room to grow. Some of them grow their stock price more than they do pay dividends. But those are the two kind of main things that people look at when they go to buy and sell stocks. That's why people invest, is for capital gains and for dividends. Now, if you are still new to this and you really don't want to jump in too quickly, another thing that you can do on your personal brokerage account, or I guess you could do it with the other previously mentioned ones like mutual funds and IRAs, is invest in exchange traded funds, or ETF. So this is another very common term. It's a little more specific, but it is a very common and important for beginner investors to know about. So I'm including it. And basically, an ETF, the way I would describe it, is a bundle of stocks and securities that are all priced as one share. So this is basically a company that will have, 50 or more stocks that they invest in, and you can invest in that one company based on the 50 other stocks that they invest in. And then they will manage those 50 stocks, and you just get the money from what they make. So it's very similar to a mutual fund in that respect, except that it's a individual stock. It's not really a blanket like a mutual fund is. So it's more specific, and it's typically a smaller fee for managing that. So a lot of people prefer ETFs over the mutual funds because it's a little more personal control and there's a smaller fee. But it is a very similar concept of somebody else is investing in a bunch of companies for you. So that is one thing is I mentioned in bullet point 3 is they do have fees as well, typically much smaller, so that's why people go for them. But another thing is, although they're usually pretty well blended, some of them can be specific to those sectors that were mentioned before. So there are some ETFs that cover the entire market. They might have some tech companies, some healthcare companies, they might have some industrial companies. And then there are some other ETFs that are only focused on really just the tech industry. So they only invest in NVIDIA, Apple, Microsoft, and that's all they invest in, is companies similar to that. So there's a variety of these guys that you can look into. And again, if you're interested in one sector, maybe look into an ETF, but they are very good for beginner investors to start with the stock market because a professional is helping you and you get a chance to see how the different sectors of the market perform while they're investing for you. And the last thing to cover is a very, very general thing, and that is what a bull versus bear market is. Really quickly, bull market is when the market's going up, bear market's when the market's going down. Now, the trends are kind of shown there too, but that's pretty much what people mean is like, oh, it's a bull market right now. They're saying the market's going up, so people are making money. People say, oh, it's a bear market, watch out. Then that's because all the market is crashing right now, basically. And the one other kind of property that goes along with them, it doesn't really define them, is just that bull markets tend to last, for a longer time because it's easier to rip stuff down than it is to build stuff up. So bull market goes up, tends to be over several years. Bear market is usually kind of like a quick recession that just kind of knocks down the price of everything. And that is pretty much everything I had to do. I hope I didn't drag this on too long, and I hope you did learn something and are interested in learning more. Again, if you thought this template was kind of good for me to follow, let me know, and I'll be making more in-depth videos about options, specific stocks, dividends, how to tax them, couple other things. I will follow this template and then kind of go outside to Excel and maybe some drawings then to help to portray them better. But basically, stocks are bits of ownership that you can buy, hold, sell, make some money. But you can also make some votes. Don't forget, if you really want to, you can go vote for the company. And they're traded through the exchanges, but also through your broker. So, or your IRA, et cetera, et cetera. They will go through those platforms. And based on the type of goal, wealth that you're trying to build, if you're trying to build for retirement, awesome. You're doing some long-term investments, try to look 10 years down the road. If you're trying to build up, if you got some free cash, you're trying to build up some quick wealth, maybe buy another car or something, maybe upgrade your car, then try to do some trades, take some time and learn a bit more about this market. But no matter what you're doing, thanks for tuning in. Wish you the best of luck. And if you have any questions, please let me know, and I'll do my best to answer them. Thank you.